Today we're talking to Jack Lowenstein from Morphic Global Opportunities Fund. Jack, firstly, could you tell us a little bit about the fund?
The Morphic Global Opportunities Fund is a fund that it's a long-short global equities fund. We use a macro overlay to try and manage risk. Our objective is to try and capture as much of the upside in global equities markets as we can in Australian dollars, and to try and manage downside through hedging. Typically, we won't capture small downturns, but our aim is to be there to make sure we get a lot of alpha through major downturns, which we'll invest, where we will cut our net aggressively as the market falls. Our fund has a minimum market cap size of 400 million US. So we're not into micro caps, but I think it is definitely good to be able to have the flexibility to move up and down the market cap range, because there are definitely different points in the cycle when large caps or small caps or mid caps will do well. October 2014 was the most volatile we've seen for global markets since we launched just nearly 2.5 years ago. To put it in very simple terms, the fund was, or the markets I should say, were down over 6% in the first half of the month, and then rallied back over 7%, or around 7% in the second half of the month. Net result, the market was up 0.25% in Australian dollar terms for the month. A lot of work for not very much action. The US market recovery, I think, was evidence of the fact that for once the morning after was better than the night before. So when the Fed finally announced they weren't going to go on money printing, and indeed were reasonably hawkish about when they might raise interest rates again, the market was a bit jittery for a day or so, and then it basically took off. Because I think that people realized that they could live with slightly higher interest rates, but provided they didn't go too high. And of course, at the very end of the month, we had the shock announcement from the Bank of Japan that they were going to accelerate the rate at which they were going to expand their balance sheet. And that really drove Japan in particular very high, but it also helped see a bit of a bounce everywhere else in the world. We had a pretty good month. Our aim is always to try and capture some of those, or to protect ourselves against some of that sharp downturn, which we managed in the first half. And then we managed to be fully invested for most of the recovery period. And we did quite well from some of our individual stock picks. In particular, we did well in Japan and in our US banking portfolio. We are roughly market weight in Japan. We've got about the same weighting as the global indices. But we got quite lucky, particularly in the beginning of the month. Our major exposures were to very low beta stocks, particularly in the drugstore sector. And they did very well, and they have a continuing re-rating. They've been in our portfolios since we launched the fund in August 2012, and they've been a consistent source of outperformance. So that helped us. We weren't in many of the exporters and the financials and property companies that did particularly well on the last day of the month, but we did have some small positions in auto companies and so on. The US positions did very well. The main gain was from our holdings in US bank stocks. We have a very large position in Wells Fargo, which we regard as one of those companies which is so big everybody's heard of it, and nobody can really believe there's much of an edge in owning it, but it's actually been a consistent outperformer for us in the 2 years we've held it. But we also have a very large long-short position in regional banks in the US. There are about 150 regional banks we can invest in with our minimum 400 million market cap test, and we own 6 of them. And we have shorted the tracker fund for regional banks to hedge out some of the market risk, because we're just going for what we regard as very high quality franchises, excellent management, and a great track record. And those 6 banks did very well during the course of the month, much better than the tracker fund. We've had a very large exposure to India since about March this year. We did very well through the election period. We then cut the positions quite aggressively until about 2 months ago, when we started building them up again. Our major exposure there is to a company called Axis Bank. Axis Bank is one of the largest banks in India. It's a private bank and has significantly outperformed all other banks plus the index. But more recently, we've also bought smaller positions in two government-controlled banks that we believe will do very well in the cyclical recovery that we think is now underway. What is exciting about India is that everything is going right for it at the moment. They've got a new government with a very dynamic leader who's going to, I think, do mostly right things. They've got a falling oil price and a falling gold price. Those are the two main imports that India has. And lastly, inflation has started to fall in India. So the very high interest rates that the Reserve Bank of India has been running to try and cut inflation are going to start to fall probably from early next year. That's going to put a real rocket under the banking sector in particular. We cut most of our active positions in Europe. We had some futures coverage still there, but we're underweight Europe, and we remain underweight Europe. The only stock of size that we have in Europe at present is actually in Turkey. And we're not that bullish about Turkey either, but this is a particularly good company. It's a company called Soda Sanayi, which is a world-class maker of soda ash, which is used in glass making. And we're very excited about this business because the market was expecting gas prices to be raised in Turkey, and they weren't. As a result, the company is now much cheaper than the market realizes, and we expect further significant gains in this stock. At month end, we were fully invested. We were in fact more than 100% invested on a net basis because we had some small positions in stocks that were undergoing takeovers where we felt there was very little downside risk. And we have hedged out almost all our risk against the yen and some of our risk against the euro, mostly back into US dollars. Look, we were fairly happy with October, being up over 1% in a month where the market as a whole is only up 0.25%, and quite a few funds were actually in negative territory, is obviously pretty good. But it's probably not good enough as far as we're concerned. Then it never is.
Jack, thank you for your time. We'll look forward to seeing you again next month.